From the beginning, Equilibrium was all about sustainability as a business strategy and market level returns in conservation investments and other environmentally sustainable investments, not kind of the other way around where you're willing to sacrifice financial return for the sake of sustainability.
Almost every one of the folks that I would call inspirational to us in green buildings, in organic foods, were operating businesses that were, in almost all cases, operating at the upper decile of their category's performance. And it wasn't just that they were selling things at a premium. Frankly, it wasn't that. It was the fact that they produced products that people wanted. So there's a tendency in some of the sustainability areas to lead with sustainability as opposed to the fact that they've keyed into something that is just functionally better. So our friends at New Seasons, for example, wanted to create local food sourcing, but they also understood that in their minds, organic meats performed better, tasted better, and what would it take for them to create a local supply chain? Well, it's not as easy as it sounds, but if you can do that and do it cost effectively, then it's something that the other grocery stores don't have. It becomes a competitive advantage. Our friend Mark Edlund at Gerding Edlund in the green real estate area, a real pioneer in LEED Gold, LEED Platinum buildings, basically built buildings and investment opportunities in real estate where the tenants, whether that was an office tenant or whether that was an apartment tenant or a condo buyer, just wanted to be in that building more. Whether that was the green roof, the idea of curating common areas to create community. These were all just better understanding of human nature, of the natural systems, how to build a better product. And I think that gets lost in some of these cases, whether it's on the investment side or on the product side. We tend to think of sustainability as an ends to itself. Well, if sustainability can't be used to create a better product, then I don't know that it's worth doing. Or a better service or a better experience.
Can you describe the evolution of the sustainable finance and impact investing space over the past 10 or 15 years? From a place of being kind of unknown and not well understood to now being something that mainstream institutional investors are talking about.
Yeah, I think actually one of the mistakes that the impact investing area did was to, in some ways, think of itself as new, right? I tend to think of this as a long-term set of continuums of how finance has been used as an execution of social policy or environmental policy. I think that the tools and the techniques that we're using trace themselves all the way back to, for example, the home mortgage. The home mortgage was a financial invention so that the social policy of it'd be better if everybody owned their house, but they don't. So how do we do that? By managing and changing the loan instruments so that we can, at the time that the 30-year fully amortized mortgage and self-collateralizing against the house, that now is, duh. That's what you would do. But at the time, that was an invention of a loan product. And all the way through to tax increment financing, the Community Reinvestment Act, the CDFIs that were part of Treasury's operations, all the way through to new market tax credits, investment tax credits. We've had a long-standing set of social and environmental stimulus, including things like NOx and SOx trading that led to, ultimately, I think, carbon trading. So in many ways, I think part of the impact, to appreciate impact investing, is to understand this long line and long lineage of innovations and evolutions in this area. I would say that what's happened in the last 10 years is that we've gone from this being a niche of investing that was occupied by, I'll call it the true believers, to increasingly the economic value of this appealing to mainstream investors and a whole new cohort group. I remember a number of years ago visiting with the chief investment officer for one of the early pioneers in the socially responsible public equities portfolio managers. And at the time, Generation Investment Management, David Blood and Al Gore's firm, was just coming into the market, and they were appealing to a whole new set of investors, fundamentally different group of investors. And in some ways, this was a classic market segmentation exercise. And I remember this pioneer in SRI saying, well, that's the new kid on the block. How did they do it? And I said, you realize if you take your two companies apart, you're actually serving very different market segments. Look at even the way you're staffed, look at your client base, and I'd be willing to bet you have next to no overlap of clients, but you almost have next to no overlap of the market segment of the clients. Sure. So your product is actually fundamentally different. You're appealing to very, very different audiences with very, very different value propositions. And so, it's one thing to say, hey, I wish I were them, but the reality is you serve very different markets. And I think that's the phenomenon that we're starting to watch taking place in this impact investing sector across almost every single one of the asset classes, is that we're starting to watch pioneers in the area having good, solid market share of the true believers, and a whole new set of folks taking and reshaping the value proposition for a different market segment.
Could you maybe explain what these different market segments are and the conversations that are going on in each of them?
Yeah. I think there is a core impact investing group. I think that's been occupied primarily by foundations and by high net worth and ultra high net worth investors. And I think that the watchword there has been, my money should do more than earn returns. It should do more. And I think we're watching a whole different set of investors, typically pension plans, sovereign wealth funds, to some extent endowments, where they're looking at sustainability and they're looking at global demographics, and they're asking the question, what are the risks if I don't pay attention to these trends, and what are the opportunity sets? So a specific example there are pension plans that are starting to ask the question, if we move to a low carbon economy, if in fact climate change starts to take place or is taking place, what assets do I have that are exposed to downside risk? And then the second half of that, which is what assets should I be in if I believe these trends are basically macro trends? And so the wording there is about risk and opportunity. The wording here is can I leverage my assets to do more than just returns? And that's a very different base to go off of the conversation. And then the third area that we see is predominantly the conversation that's taking place with corporations. And we think that we're seeing the second coming of the word responsibility. Whereas over the last decade, the corporate social responsibility was much more of a brand positioning, marketing, PR, and it's now transitioning to how do I participate within a low carbon economy? How do I make sure that I don't have a stranded asset or a stranded corporate strategy? How do I make sure that I'm not the last manufacturer of a buggy whip? And that in fact I can participate in that. A case example of that is what General Motors has done with the Bolt, not the Volt, and there General Motors has remade itself. It's the heart of almost every car company is the engine. Mm. It's sort of where the pride and joy comes from. And you look at General Motors having taken apart their engine labs and replaced it with a electric propulsion lab and electric storage lab. I don't know the analogy to use, but that's about as far away as you can get from what you think of as your heart and soul of the company, is that G8. And so now we have the Chevy Bolt that is going to challenge, I think, all of the metrics of the Tesla. And I think that says more about where we are in terms of responsibility, CSR, sustainability than anything.
Sure. So it sounds like what you're saying is that these three different market segments have very different underlying motivations. Yes. As to why they're interested in sustainability. Do you think that's an issue? Do you think it's important that these three different segments move closer together in order to strengthen the field as a whole?
Yeah, I think that look, there's a market for very, very expensive basketball sneakers, and there's a market for Ted's shoes, and there's a market for Converse, right? And are they all sneakers? Yeah. And should we unify them into the grand high-end sort of cloth, sort of? You know, I think for the time being, it's important to realize that there are market segments that are appearing, and that there are now service providers, investment providers like ourselves that are making very conscientious choices about who we are going to serve. I think that over time, these motivations may blend together, the motivations may blur, but for the foreseeable future, the next 2 to 3 years, I actually think that there's value in keeping those market segmentations separate until those market segments no longer want to be kept separate.
So what makes you convinced that sustainability is the new standard, even in the mainstream investing market? And what do you think this means for areas like conservation finance going forward?
I think in the downturn in 2008 with the crash and people having to, or CIOs having to relook at their portfolios, one of the odd things that happened during that period was a recognition, and this sounds so silly, but the recognition that most of the large pools of capital are long-term investors. They have long-term obligations. And in the basic finance classes you take, there's a concept of duration matching. And so the minute you accept that most of the assets held in these sovereign wealth funds and within these pension plans are long-term assets, you begin to ask about the resiliency of your asset. Mm-hmm. So I joke that if I'm told that I can only hold this forest for 3 years, a very viable and rational strategy may be to clear cut it. If I'm told that this is an asset that we want to hold for 100 years and keep productive, then I'm going to worry about disease management. I'm going to worry about cut cycles. I'm going to worry about how do I improve the health of the forest? How do I keep this so that it's a producing, resilient, productive, healthy asset for that 100-year horizon? All right? And I think what we're watching is more and more investors regain that recognition that they hold on to things for a long period of time. I think it's important to caveat that long-term assets is not synonymous with patient capital. There's a tendency to use the word patient capital to mean I will defer my returns, I'll put them off into the future. I actually don't think that's what we're talking about. I think what we're talking about is long-term holds and assets. So I would like my forest land or my farmland to continue to be productive. When you start accepting that, you start to see why it is that sustainability, both caring of the human component as well as the community component as well as the environmental component, is working its way into the mainstream protocols of CalPERS, why it's been a historic part of the protocol for some of the Dutch pension plans and the Scandinavian pension plans. This long horizon, this recognition that I want to maintain health of my assets, that changes fundamentally how you think about sustainability.
Sure, and do you think that recognition has trickled down yet from these long-term, very large institutional investors to their investees, to the mainstream business world?
I think that's a mixed bag. There's no question that in the business world there is sometimes a mandate, a pressure to be short-term thinking. But if you look at the great enterprises, they are thinking about long-term investments in things like R&D. And so I don't think you can paint a broad brush around that. I think that when you talk about this from an investor point of view, again, the smaller investor, the personal investor, even though they have retirement programs and retirement obligations for themselves, oftentimes they're much more highly incentivized to make sure that they can get access to the capital. All right? A properly managed $100 billion portfolio generally doesn't need to have access to broad cuts of the capital. They've already planned that into the way they manage a portfolio. Small investors tend to have very different needs or a tendency to believe that they have different needs. So I think there are differences in market segments, and it's important as an investment professional to understand that the needs of the mass affluent and even the high net worth are slightly different than that of institutions.
So, what is Equilibrium's role in further bringing forward the field of sustainable finance, and what are you particularly excited about for the future?
Unabashedly, because we serve institutional investors, the strategies that we bring to our investors have to be of a scale that they can put money to work in. They have to be a predictability or an understandability of some of the basic things, like is there enough deal flow? Can you price the deals? Can you repeat the deals? Can you manage the deals or the assets? So these things have to be relatively mature before we can take them there. That being said, it's incumbent upon us to always be in the innovation awareness business. And so we are active in working with NGOs, which we think are a source of innovative ideas in sustainable finance and impact investing. And we always ask the question, since they started it, are they capable of scaling it? Is there a germ of an idea there in terms of how they're creating these financial instruments that can ultimately go to the mainstream and be scaled? We teach, and in part we teach because we get to hang out with great creative minds in the business schools, but tap into the ideas that they have. And again, you're looking for nuggets and germs of ideas that you can then take and hone and build into institutional products or wait. So we're on boards of things like B Labs, the Freshwater Trust. We've been active participants and advisors to a number of NGOs that are in the financial instrument area, debt instruments. We work very closely with some of the DFIs, and that allows us the visibility to keep tabs on what's going on. 7 years ago now, we created the Sustainable Investment Challenge with Kellogg, and now we get to see 60, 70 schools and teams from around the world all offering up creative thinking about investment ideas, investment opportunities that come in every shape and size across the emerging markets, across the developed countries. So we tend to surround ourselves with a funnel of ideas and then really focus in on the things that are ready for mainstreaming to institutional investors.
And is there any specific area that you're really excited about?
Yeah, we're probably not at liberty to say. but there's also something really selfish too here, and some of the joy that I get, and that is being with students and being with folks that are unencumbered by a lot of legacy in the past, and they're asking the question, why? And they're coming with a presumption that, and this is a really important presumption, they come with the presumption that I don't have to ask the question, is it this or this? Can I do the right things, get great environmental and social benefits, and generate market rates of return? Can I do both? And why not? Why can't I do both? And I think that when you're around folks that are applying that kind of thinking, we just keep seeing great ideas pop out, and sometimes we're just there to help, sometimes there to advise, sometimes we bring them in-house and we want to take them into the marketplace.